Let's run through some questions on performance management metrics. To begin, which of the following characteristics is a primary benefit of a just-in-time inventory system for raw materials? Let's talk about just-in-time systems a little bit. Just-in-time systems, that's a management strategy that aligns your orders with production schedules, meaning you get your materials just as you need them, just in time. Why would you do this? You would do this to minimize your storage costs, right? Because you can order a bunch of raw materials and store them for when you need them, but that might cost a lot of money because you need to pay for a warehouse, you need to pay to insure those things. So if you have just in time inventory, that means you get it as you need it. Now, obviously, if there's a delay in your suppliers, if they have their own problems, then that's a problem for you. There are pros and cons to all possible inventory management systems and performance management systems, so take it as you will. Companies employ the just-in-time system to increase efficiency, decrease waste, again, because you are only getting things as you really need them. Because maybe in another scenario, you would have ordered a bunch of inventory and maybe you didn't ever end up needing it, which would be waste. Okay, so which is a primary benefit here? Does it increase total number of suppliers to ensure competitive bidding? I would not say this is the case. If anything, it would probably decrease the number of suppliers because you're just going to say, hey, you're my one supplier, and you're going to keep supplying me with these goods as I need them. And if anything, more suppliers is generally more of a headache. That's not really a benefit of just-in-time inventory systems. And if you have multiple suppliers, right, like you can't just tell them all to always be on call. Maybe you have one supplier who you're doing the most business with, and because of that, that one supplier is always available for you to, send your goods as you need them. What about decreasing deliveries required to maintain production? It's actually the opposite. Well, this is going to increase deliveries because if you are only ordering things as you need them, those are going to be a lot of deliveries as compared to, let's say you stock up every month, that's 12 deliveries a year. Maybe in this case, you need them weekly, or obviously it's just in time, it's as you need it. So that is likely, it's assumed to be more frequent. Increases standard delivery quantity. Again, if you get bulk purchases, you're getting things generally cheaper, there's less shipping costs, and that would be better. But in this case, you're actually getting probably a smaller delivery quantity because you're ordering things just as you need them. So if you're ordering materials to build chairs, tables, whatever you're doing, you're probably going to get less materials per order, per delivery. And then lastly, eliminate non-value added operations. This would be our answer because you're eliminating storage, you're eliminating having to insure those materials, you're eliminating waste, you're eliminating a lot of non-value added operations. That is definitely a pro of just-in-time inventory. All right, next up. A company had a choice between Project X and Project Y. Project X, great movie. I remember that's been years. The net present value of Project X is $1 million, and the net present value of Project Y is $750. The company chose Project X. What is the opportunity cost of that decision? This is a wonderful question because opportunity cost, right? Is it the difference between the two? Is it just the value of the foregone alternative? Is it the combined value of both, or is it the value of what you chose? Let's run through it. Now, there's a straight definition for opportunity cost. The opportunity cost is the cost of the foregone alternative, of the alternative that you did not choose. So is that the $1 million? No, you did choose Project X, so that's not the opportunity cost. That's your actual cost. The total cost of what you could have chosen between the two, no, you wouldn't include that, right? It's just those are the cost of something you did choose and something you didn't choose. So that just would not be your opportunity cost. The difference here, now here's where I could see that you're like, all right, maybe this could be it, but that's not the case. Again, stick with the definition. The opportunity cost is the cost of the, and this is how they say it, it's not me using this word, foregone alternative. The alternative that you did not choose, you chose to give up and not do it. It is $750. You chose to not pursue Project Y. That is the opportunity cost of Project Y. A manufacturer that wants to improve its staging process compares its procedures against the check-in process for a major airline. Which of the following tools is the manufacturer using? All right, so we are comparing our process to the process of another entity, right? Probably a competitor, doesn't have to be a competitor, but comparing our progress to someone else. Is that total quality management? Well, total quality management, that's an initiative for a customer-focused performance method which focuses on continuous improvement and quality. That's not really what's going on here. If it said we are redoing our process, being customer-focused, trying to make the entire experience positive, then sure, total quality management would be the answer. I would think more total quality management is probably Apple, right? They want every step along your way to be seamless. When you get a new phone, they want you to blink and all of a sudden it's set up. And they want everything to completely interact. Your AirPods connect to your Mac, connect to your phone. So that's not our answer here. That's not really what it's hinting at. What about benchmarking? I would say this is pretty much benchmarking, right? You are comparing your progress to someone else's. You're comparing your quality to someone else's. You're benchmarking yourself against another entity. So yeah, I'm going to say it's benchmarking. Let's keep running through though. Statistical process control. What about this here? Well, this works with statistics in controlling and monitoring a process. I mean, maybe if it said we are using statistics to compare ourselves to someone else, that could be the answer, but it mentions nothing about statistical analysis. That's why I'm going to cross off letter C. And lastly, economic value added. The economic value added approach measures economic profit where a firm's income is compared to its required return. And again, just by definition, that's not what's going on here. If the question said we are comparing our income compared to what we need to make on this project, then sure, that would be the answer. But because we are not, that's not the answer here. Letter B, we are benchmarking here. We are comparing. Benchmarking could be comparing ourselves to last year. It could be comparing ourselves to a competitor. It could be comparing ourselves to anything. But as long as we're comparing ourselves to something else, which is what is going on here. Last up, each of the following is a potential problem for a company that has implemented just-in-time inventory management, except which? We're back to just-in-time inventory, and let's see what we've got. So each of the following is a problem. So if it's a problem, we'll cross it off. Low quality inventory could cause shortages. Okay, well, if you're getting your inventory just as you need it, and if it's low quality, you probably don't have much time to complain to your supplier and get better inventory. Now, if you have a large stockpile of inventory, you have a lot more time to, yes, you're paying for storage and you're paying to keep all of those goods and that inventory there, but you have more time to assess, is this quality inventory? And if it is bad quality inventory, if you have a large quantity of inventory, you could probably pick and choose between what you have to use the best quality. So this is a problem, and as such, it is not our answer. Loss of quantity discounts could be more than just the cost of handling and purchasing larger lots of inventory. So yes, when you are doing just in time, you are foregoing your quantity discounts because you're buying things just as you need them. Generally, when you buy things in large quantities, yeah, sure, you are going to get discounts for buying things in bulk. You just look at Costco. You get discounts for buying things in bulk as compared to buying them at 7-Eleven or a convenience store. Much more expensive per unit there. So, is this a problem? Yeah, no, I definitely think this is a problem for a company that has implemented just-in-time inventory management. And yeah, so you could be losing out, like your quantity of discounts, your discounts could be more than the cost of handling and purchasing larger lots of inventory. So it's basically saying it would be worth it to buy inventory in bulk and just store it. Seasonal fluctuations in inventory requirements could cause inventory shortages. What are our thoughts here? Well, so the just-in-time method, remember, it's a strategy where materials are only ordered and received when they are needed in the process. The goal is to reduce costs by saving money on overhead and inventory expenses. So we must be able to accurately forecast demand for goods and services for this just-in-time to be productive and effective. again, if we don't have a good system to predict how much we'll need in a certain month, and obviously you've got holiday season, we've got a lot of demand around then. If you can't predict how much demand you'll have, that's a big problem, and you probably shouldn't use just in time then. So therefore, seasonal fluctuations in inventory requirements could cause inventory shortages, and wouldn't be specifically an issue for a company that has just instituted just-in-time inventory management. So that is a problem overall, right? This is a problem that could affect pretty much anyone. Even if you do keep a bunch of inventory on hand, I think it would definitely affect someone worse who has just-in-time inventory management. But this is the best answer here because this problem could affect any company using any method. And lastly, actual lead time for material orders could be longer than expected. This is for sure a problem for just-in-time inventory. If you order in bulk and you store your goods, you aren't going to have to worry about lead time. You have items in your warehouse to pick when you need them. However, this situation here, it is a problem. However, this problem, it's the best answer because it could affect any sort of inventory management system. Again, if you are a little annoyed at this question, and hey, that's fine. There are questions in this test that are being annoying. I don't make up what you get tested on. That is my job is to explain what the thought process is here. These are all problems. All 4 of these are problems. However, letter C affects all methods. A, B, and D are specifically issues for companies that have just implemented just-in-time inventory. Awesome. Well, that has been a good batch of questions running through performance management. Hope you all enjoyed. I know I had a great time. Keep going strong, and I'll see you in the next one. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.